Olá, bom dia a todos. Meu nome é Mario Leão.
Hello, good morning. My name is Mario Leão. I'm an Executive Vice President for Corporate Banking in Santander, Brazil. It is a pleasure to have you here with us today. We have three of our main executives. Sobral, our Market and Trading Area Director, Kappaz, our Treasurer, who deals with customers in derivatives and FX. And it's a pleasure to welcome you all to this multinational meeting. We are going to be discussing the forecasts and scenarios of what's happening in Brazil in the worldwide scenario and how Santander can continue to be ever closer to you and more relevant in the decisions that you have to make as multinational corporations in Brazil, and how we can support you in this moment with new opportunities. Thank you for your time. And I'm going to give the floor to Luciano Sobral. It is a pleasure to welcome you all here. Good morning, everyone. Thank you, Mario, for the introduction. I hope it is productive for all of us. Unfortunately, or fortunately, depending on the point of view, the message that we are going to be conveying is a mixed message. And what do I mean by a mixed message? I believe that we are going through one of the atypical worsening peaks. I have been working in trading and customer flows and the market for over 20 years. And I must say that I've seen everything. But fortunately or unfortunately, ever since Brazil was able to stabilize the economy in 94, 95 with the Real Plan, when Brazil finally stopped being a specific case in the market because we had external backed debt issues, we have chronic hyperinflation, we were defaulting, Brazil became again a relevant player in the international market in the early 90s when it restructured its debt and stabilized its currency, and our inflation became compatible to that of other places around the world. Ever since 95 up until now, we have seen many euphoric moments and also many depression moments. I generally say that, psychologically speaking, we have a tendency to overreact. People who watch Brazilian history from the outside in the past 25 years has realized that nothing really relevant has happened. Brazilian inflation has been around 4 to 4.5%. We came close to 2 digits in 2 opportunities, one in 2002 and one in 2015, and now recently. And we somehow always revert this scenario. So in our minds, we have been presenting to our clients and those who follow us here in Treasury in terms of market call, you know that we have had a bearish outlook. Unfortunately, that has become a true vision because the prices of assets have converged to crisis prices. The prices of the actual dollar, the pricing of the interest curve, stock papers have gone down, and that has reflected this bearish market. But the mixed message is because in spite of all of that, the price levels right now are coming to prices that I would say are almost rupturing prices. So if we don't have the mindset of rupturing, and if your mind is not a mind prone to rupturing either, we could have opportunities in terms of business and investment, in terms of hedge and individual savings that could be quite attractive depending on how the scenario is going to evolve in 2022. After this brief introduction, and I'd like to show you some charts that are interesting, but before I'd like to talk about the global scenario. And that makes me a little bit frustrated because Brazil, as I commented, ever since we were reinserted in the financial market in the 90s, Brazil is not a standalone island. We are influenced by everything that happens around the world. And ever since the peak of the pandemics in June, July, we have seen an important reversal in the prices of assets worldwide and a perspective of global growth that has been accelerating ever since last year, and that has been happening consistently. Europe is growing. China, even though it's slowing down, is still growing. The United States is growing. The forecast for 2022 is a good one, and this growth has brought something that should be very positive to Brazil, which are commodity prices. We are one of the largest, if not the largest, commodities exporter in the world, or soy. That means that the TOTs, the difference between what we sell abroad and what we buy abroad, were at their height. So Brazil should be becoming richer from an external standpoint. So there's low interest rates and high commodity prices worldwide should be causing us to have a much better scenario than what we actually see. And the question that I ask myself and that we are going to try to answer, and that's what we should think about when we make investment decisions, is why is Brazil undergoing this scenario? Why has Brazil detached from the rest of the world? And I can summarize that in one word, which is confidence. Brazil has an issue with confidence ever since early 2013, when we had this weird demonstrations that showed that something was not doing well. We still reported reasonable figures and inflation was reasonable, but people were dissatisfied with their lives. The feeling was that prosperity that had arrived in Brazil in the early 2000s was not reaching people, and that created a number of political shocks that culminated in the very polarized 2014 elections, which were decided by a hair. It also led to the impeachment of Dilma, the former president. And what is our mindset? Our mindset is that 2022, that's not what's happening right now, but 2022 elections in April, June of 2022, the elections are going to be driven by economic factors. How do we grow? How do we reduce inequality and inflation? Having said that, we believe that the base scenario for the 2022 elections and how Brazil is going to evolve is going to be a healthy discussion and how to solve those issues. And in order for that to happen, we believe that we are going to have perhaps calming down of political factors, convergence of discourse towards the center, the left-wing candidates and the right-wing candidates, and the new names in the center should entertain a conversation in terms of breaking peace to dissuade Brazilian economic problems. Given the price levels that are extremely stressed in terms of FX, trade, what we want to tell you is about this very concerning picture that we see right now, but with an important upside. The external scenario is very supportive. It's still constructive for Brazil, but at the same time, we have an asymmetry in prices that could play in favor or some investment theories. And Rafa is going to explore with us how we can benefit from that in the future. I'm going to show you my presentation now so that you can take a look at that from a visual standpoint. I believe that you can see it full screen now. Okay. So right now, everything comes down to the left-hand side chart. Anyone who talks to an economist, who talks to a foreign investor, who talks to a politician, a trader, or portfolio manager will realize that the discussion around Brazil has to do with the debt to GDP estimates. Here is the GDP trajectory expected by the market at several moments. This blue line that you see here is what the market expected to be the debt to GDP before the pandemic. In 2019, we had approximately 72% GDP debt, and the market expected that between 22 and 23 we would have a peak, and then we would slowly reduce that ratio by 2028, which would be lower than what we had in 2019. Why was that expected by the market? Growth forecasts, which was good at that time, and all the reforms carried out by Brazil from the Temer administration that culminated in the Social Security reform in the Bolsonaro administration, which would yield fruit and would bring our debt down again. But the pandemic came and it destroyed Brazil's growth capacity, and more particularly, it caused an increase in public spending due to the reaction to the pandemic. The government needed to help people, and so in November 2020, we have the new debt to GDP line. Take a look at that leap. We expected the GDP to debt of 73%, and now it's 100% of the GDP. That explains why the FX has gone down and why do we have signs that interest rates in Brazil should go up. Ever since the end of last year up until now, September 21 data, which is this red line below the black line, you see that there has been an important improvement, a significant improvement compared to November 2020, but that improvement in the short term was due to inflation. The administration, as you know, raises money in terms of what we expend. That has been influenced by the inflation, and the governmental expenditures take a long time to be readjusted. So government workers and pensions, so there has been a gain for the government, and that's why that expected debt to GDP, which was expected to be 79%, goes down and comes up again. The market was comfortable with this scenario, but then a month ago, more or less, a few weeks ago, there has been a discussion or started a discussion about the government proposing to break or breach the cap for public expenditures to finance some aid and Social Security. So how are we going to bring this debt to GDP down, and how the government is going to explain that? So that explains this worsening in the short term. The second chart that we created about a month ago, well, we created two growth scenarios. we drafted or we devised two growth scenarios. And I remember that when we first created it in September, we had two Selic scenarios. On the left side, you had a Selic at 8.5%. That is no longer possible. And in the right-hand side, which was the pessimistic scenario, Selic would be at 10.5. But now we believe that it would go up to 12%. And in this matrix, we crossed two types of information. We got several levels of confidence and uncertainty, many indicators in Brazil that show the degree of confidence and uncertainty, and we crossed that with TOTs, which are the commodity prices. When commodity prices go up, Brazil is doing well, and when they go down, Brazil is doing badly. So we have a negative, basic, and positive scenario, and we cross with the positive, basic, and negative scenario for commodity prices. If we look at the right-hand side chart, with a Selic at 10.5% or more, in order for a recession to happen, you'd need to have very low confidence, low commodity prices, and Selic would need to be at 10.5%. But ever since, there has been a negative confidence level in the margin with this breach of the cap. Commodity prices are still supporting Brazil, but Selic is going up to 10.5%. So the probability of a recession next year has increased, but is still not our basic scenario. Good part of the economy in Brazil is tied to services, and the reopening of everything in the city of São Paulo, you can judge that by traffic. Traffic shows us that this reopening of the economy is going to create some positive inertia, which will prevent us from technically going into recession. But if the probability of a recession was 0 a month ago, now it's no longer close to 0. The third chart, to talk a little bit about FX. On the left is the investment, the inflow portfolio investment, and we split it into three categories: fixed income, stocks, and funds. We are going to focus on the two first ones. The red one is the inflow investments for equity, invested in equity, and in black, the inflow of cash for fixed income. Observe that in 2006, between 2006 and 2015, there was a huge investment at the peak between 2010 and 2011, and then up to 2014, we had almost $80 billion coming into Brazil in terms of equity. But the area in red is bigger or larger than the black area because people came in to buy equity from Petrobras and other companies. But then in 2014, when our interest rates went up because of inflation, a lot of money came in, invested into fixed income. So between 16 and 19, Brazil lost investment rating. Money starts going out of Brazil. And in early last year, during the pandemic, it definitely goes down. Nothing similar to what has happened in the past with, a small increase that we had. Imagine if we had a positive shock next year, and if we were able to show that people that there is a path to a solution. So this flow that has been negative in Brazil could be reversed. On the other hand, on the right-hand chart, we see something that is not relevant, which is the outflow portfolio investment. If you talk to people in the bank private area or asset area, you will realize that locals are flying abroad to invest in equity in the US, crypto coins. The Brazilian Central Bank issued some data that 15 to 20 billion dollars left Brazil for crypto coin, and it was an all-time high for Bitcoin. And there's a good side and a bad side regarding that. The good side is that there is a diversification. It's always good when Brazilians have part of their investments abroad. That creates some level of heftiness. You're not depending on the Brazilian economy. But on the other hand, it shows a lack of confidence in the country. Brazilians traditionally always left their money in the country, but now they are not doing that any longer. And in our opinion, it's because the interest rates were distorted in Brazil for the past couple of years. You didn't have an interest rate that would pay off the risk of having the money here. With the reversion of the interest rates, we hope that part of this flow is not reversed. I mean, Brazilians are not going to take their money from abroad and bring it here, but at least they would stop bleeding it abroad. If we can lower the temperature, politically speaking, and there is a solution to the Brazilian fiscal issues. From a trading standpoint, the left-hand side chart and the right-hand side chart tell you more or less the same thing. What they are showing, well, they're actually giving you three types of information. The red line is the risk premium for Brazil for the next 10 years. The gray is the real risk premium, and the blue one is the Ibovespa stock exchange risk premium. Between 13 and 2020, risk premiums were more or less tied together, and they were close to zero, which meant that, relatively speaking, the three prices, interest, exchange, and market, were more or less the same. But from early 2020 on, we see that the Brazil risk premium detached from zero, which means that we started to have Brazilians either send money abroad or a stopped inflow of assets here to Brazil. So that was the first indicator that was something going wrong with Brazil. But at the same time, the interest rate didn't move, as if Brazil had many issues with real, but was developed in terms of currency and equity. And then we have another phenomenon that doesn't make any sense, and we are now seeing the correction of that. What we saw was the blue line going down. The premium risk for equity was going down. The risk rate didn't go up, and there is a depreciation of the FX. But from early July on, the red line started climbing, which means that the interest rate went to up to 12%, and the light blue line, which was the Ibovespa, converged to the real prices. So the distortion that we had between the assets was undone, and now more or less everything is priced at the worst level. So if we believe that there is an upside, if you believe there is an upside for next year, that could be a minimally reasonable solution for this political instability, this chart should be converging to zero. There should be some room for a drop in long-term interest rates, for the recovery of the stock exchange, and for the real to value. Here we show more or less the same convergence happening to the bad side, like the real was the red line, had a risk premium that was positive, so you're comparing it to peers. You get the real, the interest, and the stock exchange, and compare to Brazil peers. When it's positive, Brazil's performing better. When it's negative, Brazil's performing worse. And observe that the real has a constant downward trend. The red line doesn't stop falling, and the gray line and the blue line are better than other places around the world because we were cutting down interest rates, and our stock exchange had a rally that was explained by IPOs, commodity prices that pulled Petrobras and Vale up, but everything is now converging down. So this chart gives you the same information as the previous chart. When you look at Veja Magazine, Estadão newspaper, Global Networks, when you see people complaining that the situation is really bad, you must remember that the market reflects that. People's perception sometimes doesn't tie with market perception, but right now that's a reality. If you see that the market is very positive or very negative in comparison to the perception, then you could do something. But everything is now priced at their worst. So given what we have in the short term and the political aspects, we shouldn't have significant worsening in the market due to that. These other charts here, particularly the one in the right, I'm going to try to explain something. When we have this chart here on the x-axis, you have gross debt for many countries, and on the y-axis, you have FX depreciation since December last year, December 2019, actually. And we try to find a reason between gross debt and FX depreciation. And it makes sense to observe that countries which have a GDP debt that is higher, they are on the right of the chart, tend to have FX depreciation that is worse. But when you look at Brazil, you can see that even according to these metrics, our GDP that is similar to that of India, but our FX depreciation was 15% higher than India's in the same period and much higher than any other countries. So we are now trying to find and show you information so that we can debate with Rafael Kappaz that it doesn't matter that we have a GDP debt that's worse or fiscal issues. It seems that our financial indicators start to become exaggerated. The confidence starts to play and to take a toll. This chart's here, this one, terms of trade and BRL. What does that mean? This chart shows that there is a correlation, if you observe, until 2020, almost a perfect correlation between the gray and red lines. And what does that mean? The red line is the price of, the real price of the dollar, and the green line is the TOT, which is the price of exports of Brazil divided by the price of import. Whenever terms of trade improve, the real is valued, and when it worsens, the real price goes down. So I inverted the TOT on the green line, so we compare in the same basis as real. And from 2020 on, when the pandemic started to slow down in 2020, the real has stopped responding. Look at this big alligator mouth. And part of this improvement in this TOT is already being reversed because some commodity prices started dropping, but the real is not reacting. So we have this major gap that needs to be closed, and that can be explained by confidence, by trust again. This gap before was due to another issue, which was not confidence. It was an error in monetary policy. We had a worsening of the Brazilian scenario. We started seeing a worsening of inflation, and the Brazilian Central Bank kept the interest rates very low or cut them down. when you look at this last chart on the right, we created a metric that we believe that works very well. We say carry to vol. What is that? Implicit volatility of 3 months for the FX, and we compare it to the interest rate of each of the countries. If you look at the real value of the dollar is the red line. Between 17 and 2020, look at what happens with the carry to vol of real. We were much better than Mexico, much better than South Africa, similar to Russia. And now we started dropping drastically because we were cutting down interest rates and volatility is high because of local issues. So a metric that was good for foreign investors, investors would think it's a reasonable volatility and positive return. But we dropped that with an increase in vol and a drop in interest rates. And between January 2020 and January 21, we have the worst carry to vol. That's why we are sending money abroad to buy stocks abroad, to buy Bitcoin, and why investors are not investing in Brazil. But with the increase in the interest rate, the red line for Brazil has already surpassed that of South Africa. It's coming close to Mexico's, but is still far from Russia, which means that we still have a lot to improve, be it because the interest rate is now at 7 and it's going to come to 11 or 12, but the effect of the interest rate should reduce exchange volatility, and that should support us in order for us to have a marginally better real in terms of margin. Now, if we continue talking about real, the situation is not good and prices reflect that. On the left, we have a BRL model for FX. It takes CDS and interest rate differentials, volatility, interest rates abroad, commodity prices, everything. And if you observe, the model is red and black is where the real actually is. Look at how this model is good. Between 2018 and 2020, the lines are one and the same, but now they are detached, those lines. There's almost one figure, one real of difference between what the model says that the effect should be and where the effect actually is. Why? The model stopped working. Why is it not working anymore? In our opinion, that results from a lack of confidence. So if we can improve that next year by bringing peace and, making fiscal improvements, there should be a convergence. But if everything goes wrong, the model will indicate that market prices are correct and we would have the negative outcome, which would be higher interest rates, worse effects, and even worse inflation. So before we go on to Rafa, we are going to talk about inflation and interest rates. On the left side, we have break-even inflation for 10 years in Brazil ever since 2009. And why do I want to show you that? Because as we have seen here at the bank, we see a lot of companies issuing debentures and IPCA, and the investors are demanding this type of debentures. If you talk to credit funds and others, they are buying assets tied to the inflation. But what happens is that when Brazil dropped the interest rate, we had major IPOs and debt issuing, which made the market flourish. But when we compare these charts, the average of break-even inflation between 2009 and 2016, it's close to 16%. We had stability, reasonable stability of inflation between 2009 and 2015. They are around the average. There was an explosion between 15 and 16. That's when Brazil lost its investment grade at the end of the Dilma administration. That was reversed in 16, 17. the Brazilian Central Bank and Enrique Meirelles at the term administration brought inflation substantially down. A good time, a good period. We had this break even, but now look at the explosion of break even for inflation. For 10 years is above average between 2019 and 2026, and the double of the inflation. So there is a lot of opportunity there. Rafa is going to explore that. So if you have that tied to inflation, there's a lot to be done in this market. The right-hand side chart is the same as the left-hand side chart, but the gray area is where there was a fluctuation between 2010 and 2016, and in the red line is where we currently are. We are right at the middle of this band. So if you believe that Brazil will control inflation in 2022, between 2022 and 2026, and do you believe that all of this confusion is going to be solved, this break-even of inflation will go down again, which seems to me that's exceptionally high. Inflation is in the two-figure mark, and it's a mess. But if you believe that it's going to be reversed, there is much to say about that. But on the other hand side, you have two different information here. The left-hand side shows you the nominal rates for 10 years. Look at the movement. Brazil interest rates are already on average for 2016. It only loses to the peak of 2015 when Brazil lost its investment grade, and a lot of that was leverage, foreign people liquidating their papers and sending it abroad, almost 500 base points above the price levels in July of last year. So if you have pre or post that, there's a lot of swap opportunities or curve inclinations that you could take advantage of. On the right-hand side, the consequence of break-even of inflation is the real rates for 10 years. The real rates for 10 years are still not close to the average numbers in the past. So break-evens of inflation are up. Nominal rates are on the average, but real rates, nominal rates minus real rates is the break-even. Real rates is still below, so there is not a lot of upside to close. So because our fiscal situation is bad, whenever you have real rates down, you have inflation. So there would be more upside on the break-even and nominal rates. So if you have exposure in inflation, real rates, CDI, you have a major opportunity and a lot of things that you can be doing. And before we conclude, remember that I talked to you about carry to vol, volatility goes up, interest rates go down, and vice versa. That changes the dynamics for FX. It's only bad news. Every day there is a new thing. What's the average price for real in face of the dollar? 537. 537 to 550 is not much of a difference, but the carry in the past 12 months was 3%. The carry of this real is going to be close to 12%, which means that hedging it now, buying at 550 is a forward down the line of about 6. So from now on, two things started to happen. Real dollar FX is not appreciating, and the carry. And this is one of the charts that shows stock exchange positions. So those who bought stocks on October 2020 and bought dollars to protect it, well, observe that this chart starts at 0. So I start with a P&L equal to 0. And look at this position. They are only making money between October of 2020 and March 2021. Increased in FX and market exchange and drop in the dollar prices. People who did this transaction a year ago are losing money after making 6 million reais, which is the peak of result which happened at the beginning of this year. So what's going to happen? In March of 2021, the interest rates went up. So the dynamics between risk and hedge changed with high interest rates. So one of the conclusions is all hedge decisions you make from now on is different from the decision that you have made so far, because the dynamics of interest rates have changed when compared to 6 months ago. And I believe that is about it. I'm going to give it to Rafa, and we can talk about the conclusions of what we have just discussed. Well, first of all, thank you. I believe that you brought us a lot of information so that we can discuss for the next few minutes. I believe that summarizing everything that has been said, one of the main issues is confidence. We have a confidence crisis in the country, and we see that reflected in the market prices and factors, which are now at excessive levels, and that has opened opportunities. And the idea is to discuss which are these opportunities and try to translate these numbers and information that you brought us in real opportunities for those who are watching us. I believe that the first point here is to discuss what we are living now and prices within the market, which are similar. And there is a detachment between what we are living in Brazil and the external market. And obviously, in our point of view, which is what we want to bring you, gives you opportunities. So the first point that I would like to discuss with you, and eventually, is for those who believe that next year we could have a scenario, as you said yourself, of less polarizing and eventually solution for the fiscal issues that we have been tackling. Well, I wanted to talk about these all separately. I wanted to talk about FX because for multinational corporations, FX is one of the major topics. Esther and I were discussing, yesterday we were at the luncheon and we were discussing the results of multinational corporation here in Brazil. And our results in reais were good, they said, but when we translated into euro, the parent company didn't like that so much. So the timing and the cost for hedging has changed quite a bit from the standpoint of what we had a few months ago. We discussed a great deal with our clients that the cost was very low, that the interest rate was at 2%, U.S. interest rates close to zero. The hedge in the long term was cheaper than any other time in Brazil. But we understand that eventually when the scenario becomes stressed, that companies start hedging, and that's where you have the dichotomy. Once you have the stress is when you have the opportunity to change your dynamic a little bit and treat it differently from what you have done before. So we talked about excessively devaluated FX, a hedge cost that's somewhat high if compared to what we saw, particularly in comparison to the past year, not much different from what we saw in crisis periods. So if we are buying dollars now, we are talking about 6.10, 6.15. So this is the first point, a topic that I wanted to explore and that we didn't talk about, the hedge factors. The hedge cost has 2 points, the local rates and the carry, but you also have the external interest rates that play into it. And when we talk about external or foreign interest rates, I wanted you to tell me a little bit about the FX coupon and what and how that could make the hedging cheaper in the long run or in the medium term. Hedging is something that here in Brazil we have always associated to buying dollars, but we also hedge by selling in in the golden periods, we had exporters selling dollar in the long term, selling dollars for 5 or 10 years, and we saw a flow that has disappeared, but I believe that could come back to Brazil, which was the Uridashi and Toshins, because in the 2008 crisis, when we started this trend of zero interest rates, and Brazil was seen as a country that was paying reasonable interest rates, we saw a lot of retail investors that needed yield to come here to sell long-term dollar to do the arbitrage in reverse so that you can sell it higher. So, we lowered our interest rates and we became embroiled in all this confusion, and we don't have long-term dollar sellers in Brazil. That's one of the reasons. The second reason is because due to this single direction exchange coupon, that we don't have sellers of long-term dollar, and this market is not very net, and a lot of funds that were arbitrating these coupons, which are the FX rate abroad plus a premium for selling it in Brazil. But in the past, when we used CGS and, another player, which was the arbitrator, were paying 100 points above LIBOR. And now it's, these people are outside of the market because Brazilian risk is high. So the only reason why the hedge in Brazil for buying dollars made sense till early this year was because local interest rates were only going down and the FX was only depreciating. So if you had inflation going to 5.7, the actual interest is minus 7%. Minus 7%. So people who had money in CDBs lost 7%. But now it's going to plus 4, plus 6. So there is a shift. And the exchange, as I told you, is no longer going to depreciate. So all the hedge dynamics, and I want to go back to the chart of the guy that bought in the stock exchange and FX and now is losing. So now if you sit on the board of a company and you say, look, let's hedge the company by buying FX, this decision is not as trivial as it might have seemed before, but we still don't have the other end, which is, the selling of dollar in the long term. People are afraid of that because we are undergoing a transition. And there's another factor, a risk factor, which I haven't mentioned, which is the inflation topic, is a reality in many places around the world. US, in Europe, probably the central bank in the US is going to have to increase interest rates. So, 10 years in the United States would be 1.5. Here it was 7, it's going to 12. So perhaps next year we might have a partial reversal of that. We could change the coupons in the long term due to that. But the main conclusion, Rafa, is that all FX and hedge discussions in the past 3 or 4 years is now in check. To buy forwards where they are means that you must have a bad Brazilian dynamic. One thing is to decapitalize your company and invest abroad because S&P is much better than Ibovespa. But the other thing is to keep assets here, and this dynamic needs to be taken into consideration. So I believe that is my conclusion regarding the hedge topic. Great. So I think you brought us additional information, which is the matter of inflation. We saw a hefty market in terms of IPCA indexed inflation, investors that were looking for protection, companies that were issuing in the long term, and many of those those who didn't have any receivables indexed to the inflation or by the inflation, trying to hedge, and the change of indexing from inflation to CDI, something that was new in Brazil. Hedging for interest rates in Brazil 3 or 4 years ago was something that was unheard of, but now there is an industry that is demanding that type of protection. Something important in terms of inflation dynamics, interest rates, etc., is that the coupon for NTNB that indexes and prices these issuings, the risk-free rate and premium by each of the issuers, that is still space for that to open, considering nominal and real rates, and that could give us a possibility of any company who is looking to issue in the short term or eventually to restructure or its debt or extend its debt, they would have some space to use that coupon. And now we have many ways of locking that coupon at the bank. So I wanted to explore this topic a little more. How do you see this movement of real interest rates? And I agree that in future issuance that could have an impact in the local market. First thing that I believe that we must stress is that luckily Brazil a few months ago approved the independence of the Brazilian Central Bank. So now the chairman of the Brazilian Central Bank cannot be fired by the president. So the Brazilian Central Bank, which historically in the past 20 years was operationally autonomous, there was some pressure, but in very few periods there was political pressure. So they have a reputation to care for, and the Brazilian Central Bank will have 2 years, this new president, this new chairman. They are going to have to deal with a new president, and considering what happened in the past year, from inflation growing 3-4 to 10%, they have major pressure not to repeat their mistakes. So the Brazilian Central Bank will do whatever they need to do to bring the inflation down, and that in fact is already happening. We have a Selic rate of 13.75% early next year. Listen to Santander, because we are honest in our discussions. We are not going to tell you silly things. A lot of people said that the interest rate was tending towards zero. Well, now we have the Selic rate going to 14%. I'm not going to be able to say a scenario that is going to go to 20%, but I'm not going to sell you that. Answering what Rafa asked, because the Brazilian hedge market is one direction, only in this golden period when we had this flow from international investors, the FX market was always one direction only, as the inflation market is. In the private, you cannot sell LCI or bonds in reais. Brazil doesn't buy that, because every now and again we have governments that do something silly in terms of inflation. Pension funds that had some issues because their actuarial rates were above the interest rate. There was an opening when they started selling NTNB. So if you are a sophisticated investor that talk to Rafa, who's also a sophisticated guy, you realize that that creates major market distortions throughout time. Because if you have an investor who wants to have 6% of actual interest because is their actuarial, and the curve goes to 9 or 10%, the break-even of inflation is something very volatile. So I'm very much against this type of passive management. You know, sometimes you have to be overhedged or underhedged or undo what you've done. So in 2 weeks, what happened to the interest rate curve is that it is reversing. It's the first time ever since 2014 or 2015. In the past 5 years, we haven't heard of that inverted curve. So the market expects the interest rate to be taken to 13.5, and some point in the 2023, 2024, this interest rate is going to start dropping. So you have a major opportunity to lock that down. We had many fights in the good sense with clients saying that, do, or they called that you can. It didn't make sense not to have that. A lot of companies didn't do that, and they stayed with CDI. And in the past 12 months, the average cost of your debt in CDI, forgetting the spread, was 3%. Next year is going to be 12 or 13 or 14%. Imagine the impact on the balance sheets of the companies who didn't manage that correctly between 1 year and the next. So now you have the opportunity to do the reverse. There's a lot of things to be said about that. Now, quickly going back to the hedge topic, I have a theory, Rafa, that I don't know if you agree with me. A lot of companies do short-term hedging and they roll it, so they don't buy a forward for 10 years, 5 years, 4 years. They do short-term, but the short-term is still at 7%, which is the CDI rate. When you consider that's going to go up to 12, 13, 14, it's going to become very expensive next year. So we are going to have a lot of debates with clients next year about that, because imagine that everything works out, that the fiscal issues improve, that the country calms down, that the interest rates, are going to be held high by the central bank. You could, face a considerable loss if you don't hedge appropriately. I think there's a lot of dynamics that we don't have a lot of time to talk about, but you are invited, all of you who are watching us and those who are watching us later, to get in touch with us so that we can look at your portfolio, look at the individual characteristics of each of our clients, and have more specific discussions. One last topic, Sandro, so that we can close. We talked a lot about the uncertainties that we are facing and the excesses that we are seeing in the market. And obviously, when we talk to a lot of the companies, many of them tell us that, oh, my management is more conservative. I don't take advantage of these opportunities. I have a management line and I follow that in spite of what the market is doing. Well, the provocation here is that this type of management could cause you an increased cost by not doing something. So along those lines, and going back to the interest rate issue, we see a lot of opportunities in terms of this very open curve, pricing interest rate at 13% next year. And one of the best things that we do here at the bank is in the interactions that we have clients, when you have the traders and you could see both sides of an issue. In your point of view, the scenario that prices interest rate curve at 13% next year, does it make sense? Is it a move that you would do in terms of risk management? Rafa? What happens is that at the beginning of my presentation, I told you, and this is not a characteristic only of Brazilians, markets are in cycles. If you ask the people a couple of months ago, I believe that we are still live. So I believe that we can move forward, Sandro. Are we live? Yes. Okay, guys, sorry. Sorry for the interruption. We are back. So what happens is along this pro-cycle line, we saw in 2018 crisis, I believe that Rafa was in the market already at that time, that the companies had become a hedge fund with toxic transactions that cost people a lot of money. I believe that created an aversion to risk in companies. They are too conservative nowadays. You cannot be a hedge fund within the treasury of a company, but you cannot be that guy that has one policy and only follows that policy blindly. If you're listening to the traders and myself, we change opinions often. I don't have the mandate to be earning or losing money all day, no stop. So we change our speech along the time. So we are in an in-between position. The second message is I don't like extremes. I don't like to sell, zero interest rate, now it's going to explode. No. I believe that Brazil is a cyclical country. When you talk to people and you look at their statement, if you have money investments in Brazil, you lost a lot of money. So these high interest rates, the economic activity is going to come down. There will be an effect on inflation. So answering without, being on the fence, I believe it's too much. I think it's going to go up to 12. I think it's going to work out. And when interest rates are at 7 again, we are always going to try to be contrary. But the answer is that I believe that the outlook's a little exaggerated, and we need to start paying attention to the asymmetries, because the asymmetries from now on are positives. So I believe that we have come to the allotted time. Sandro, thank you so much for your time. Here we leave you with this invitation to come and hear about what we have discussed at a deeper level. Come and sit with us. And now I'm going to give it to Esther to close our event. Yes, we are out of time. Thank you so much, Sandro and Rafa, for your participation in this fourth meeting with multinational corporations. I believe that we are leaving with a lot more inputs of what's coming ahead, a context, the change in interest rates, inflation, the stock market. I think we are left with a lot of provocations to think about opportunities, lots of ideas on how to position yourself in the following months, and count on Rafa and the Santander team to go deeper in the issues that you have in mind, and let us help you manage your business and change your strategies for hedging or improving your hedge strategies. We are ready to go into a deeper conversation. Count on us. Tomorrow we'll have a second session. It's going to be a session dedicated to a very relevant topic, which is tax reform, and I invite all of you to participate with us and follow us. Thank you very much. Have a good day. Thank you. Bye-bye.